Are interest rates about to fall? Today we're looking at one of the biggest questions in global finance. Are interest rates finally about to fall? Central banks have held rates at their highest levels in years to control inflation, but recent signals suggest that shift may be approaching, cautiously, unevenly, and heavily dependent on data. Over the past week, the tone from the Federal Reserve began to change. New York Fed President John Williams, one of the most watched voices in monetary policy, indicated that policy is now restrictive enough to slow the economy. His remarks suggested that the Fed may soon be in a position to move toward a more neutral stance. When the New York Fed hints at this, markets listen. Historically, such language has often preceded a policy pivot. But not all Fed officials agree. Some remain concerned that inflation is still too elevated, and they point to a labor market that has not softened enough to justify a shift. This internal divide is playing out publicly, and it's why markets have been swinging sharply. The data is mixed, and even inside the central bank, the path forward is being debated. To understand what might come next, it helps to look back. Historically, major rate cycles follow a similar pattern. In the early 2000s, after a period of tightening, the Fed paused before cutting once the economic slowdown became clear. In 2008, the pivot happened rapidly as financial stress intensified. In 2019, the Fed eased gradually in response to slowing global growth. In each case, the first signals came through cautious comments from key policymakers, not dramatic announcements. What we are seeing now fits that same pattern: careful hints, recognition of cooling forces, and the early stages of debate inside the institution. Looking globally, central banks are not aligned, and that divergence matters. The European Central Bank has kept rates steady as inflation moderates and growth slows across the Eurozone. The Bank of England is signaling caution due to persistent price pressures, while Canada is facing a more fragile economy and may move earlier than others. In Asia, the Bank of Japan continues to normalize policy very slowly after years of ultra-loose conditions, while Australia's central bank remains focused on inflation risks. These differences shape global markets. When major central banks move out of sync, currencies shift, capital flows change, and investment strategies adjust. Global investors are watching not just the timing of the first rate cut, but how coordinated, or uncoordinated, the world's central banks will be. For households, the stakes are straightforward. Lower rates would ease pressure on mortgages, variable loans, and credit costs. Families carrying heavy financial burdens would feel the difference quickly. But if rate cuts are delayed, high borrowing costs will remain a challenge for the near future. For investors, this is a period that requires discipline. Bond yields can swing sharply on central bank language alone. Equity markets react quickly when expectations change. Anyone exposed to interest-sensitive sectors, from real estate to financials to consumer credit, needs to track central bank communication closely. So, are interest rates about to fall? There is a real possibility. The door is open. The language is shifting. But no central bank wants to repeat past mistakes by cutting too early. The next steps will depend entirely on incoming inflation data, labor market signals, and broader economic conditions. We will continue watching every development and bringing you clear, unbiased updates. Thank you for joining us, and remember to subscribe to Investing Insight for more grounded financial analysis.